Hello, everyone. Thank you for joining us today. My name is Corey Daharsh. I am joined with Charles Seaman, and we are here with the topic of things that passive investors should be aware of when looking into syndication investment deals. Again, as I just mentioned, our presenters today are myself, Corey Daharsh. I am a business development specialist with Advanta IRA. I've been with the company for about 6 years now, serving as a client account manager for a number of years, processing day-to-day client transactions, and now actually transitioning into a sales and educational role after I've moved to Western North Carolina. And I currently manage the region of the Carolinas, Tennessee, Virginia. So if you're in this Southeast region and have any interest in self-directed investing, please feel free to reach out. My contact information is right here on the screen at this moment. And I'm joined today by Charles Seaman. He is currently a senior acquisitions manager and asset manager at Cashflow Champs. I know he's got a few other irons in the fire. I actually met Charles because he's a co-host of the Multifamily Investor Nation Charlotte group, as well as I believe Charles also runs a investor underwriting course that he does weekly also. And I believe he's got some experience in trading on the stock market as well. Charles, thanks for joining me. Anything else of your experience, history, background you'd like to share with our audience?
Hey, Corey, thanks for the introduction. I think you did a wonderful job with it and gave me a nice warm welcome to the audience today.
Perfect. Well, thank you very much for joining me, and I very much look forward to this presentation. I've been coming to your meeting for about 6 months now and always a wealth of knowledge, so I was really excited to get you on board with one of our webinars here.
And I'm equally excited to be here.
Perfect. So just for all of our attendees, the agenda today, I'm going to cover who Advanta is and what a self-directed retirement account has to offer you, why investors switch over to a self-directed account. I'm going to have a brief case study just on how to invest into a syndication deal. And then I'm going to hand over to Charles, who's going to cover what you should look for as a passive investor when you're considering syndication investments. And at the very end, after Charles has presented, we will then go over all of the questions and a conclusion. So please, if you are looking at the GoToWebinar window, you can drop all your questions in the question box. We will address those at the end so we can get through the full presentation and then go over all of the questions that have relevance to today's topic. So please don't hesitate, throw it in there. We will address them at the end, and I will be happy to read those off and make sure we get those addressed. The key takeaway points that I would like everyone to learn or glean from this webinar today is, firstly, conduct your own due diligence thoroughly. When you're a self-directed investor, the self is very important here because you're directing the investment you make. You're not using a fiduciary or financial advisor in your retirement custodian, so you actually serve as that role in making sure you have vetted out and trust the investments you're making for the growth, whatever your goals are, cash flow, long-term growth, any other type of goals that you specifically have. Make sure the deal you're researching has those components that you're looking for. The investor in a retirement investment is the retirement account, not yourself. So you'll never provide your social security number or tax ID. That'll all be filtered through your tax sheltered retirement account. That is a key point that I'd like everyone to know. When you're looking into these types of deals with a retirement product, you're actually executing them in the name of your retirement account, not yourself as an individual. And the third and final key takeaway point for today's topic is that syndication investing as a limited partner does create completely passive income. In other words, mailbox money. You put your money out for the investment, and the actual general partners are who do the day-to-day work of the investment, and you just sit back and wait for those proceeds to come back in either dividends or a final payout at the end of the investment structure. Now, who Advanta IRA is? We are a self-directed IRA administrator that have been in business for about 20 years now. We've got just over 8,000 active clients and just over $2 billion in assets under management. We are very secure in that all of our cash held in accounts are held in FDIC insured institutions up to applicable limits. And we have a high emphasis and specialization in specializing for educational content like you're participating in here today, and also the client services We pair each client with a dedicated account manager. Again, I served in that role for about 5 years. So you have a one-to-one point of contact. You always know who you're speaking with, and they get to know who you are and what your investment strategies are. And you build a rapport and relationship over time so that when you reach out to us, we know what to expect from you, how to answer your questions, and how to help you make your investment goals in an efficient manner. Now, if you've not heard about self-directed investing, that is pretty common. Only about 4% of IRAs in the retirement industry in the US is self-directed accounts. And to put that into perspective, I believe the total dollar figure of the whole retirement account industry is somewhere in the figure of $27 trillion. So if this is the first time you're hearing about it, you're not alone, but please keep this in mind and express to your friends, relatives, whoever you may know that could benefit from a self-directed strategy, or at least learning a little bit more, that we're a great educational component. We always provide free education, and we have a few different channels of doing that. We have events like we are participating in today. These events typically go on to our video library on YouTube, where you can see this video as of tomorrow's date. If you're not watching it live, we typically always post these webinars the following day to our YouTube channel, and they live there in perpetuity. We also have a blog if you're interested in industry information and knowledge about the retirement account industry. So feel free to check out any of our content. If you're in one of our areas where we have a local office, which would be the Largo, Florida area, the Atlanta area, and myself up here in Western North Carolina. We also sometimes do in-person meetings and lunch and learns and educational content. So feel free to check out our events calendar on our website to see what we might have coming up with either a guest you're interested in or a specific topic that we're covering ourselves. And the final piece of educational or networking content I'd like to convey to you is that we put on a bi-weekly investor networking forum called Pitch, Promote, Prosper. We did just do Pitch, Promote, Prosper last week, so the next one you'll see is going to be next Friday, the 17th. And this is a Zoom call every other Friday, 12 noon to 1 p.m., 1:30 Eastern, where you as the investor or the investment provider get the floor to speak to everyone in the meeting and say what you have to offer or what you're looking for, and network from there with the fellow investors and like-minded individuals. Please feel free to check it out if you've got interest in finding your next deal or promoting your next deal. We're all there to collaborate and work together. Now, there are a number of different types of self-directed plans you could utilize. Most people are familiar with a traditional or Roth IRA, but there are also lesser known IRA products like a SEP or a simple IRA for small business owners. You can always roll over a former employee plan like a 401k, 403b if you're a teacher or educator that has left your current position, and even a TSP plan if you've left the military with some retirement built up. You can roll those into self-directed plans without any taxable consequence and start self-directed strategies. We also offer individual 401ks for small business owners, health savings accounts for either an individual or a family, and education savings accounts if you're trying to save up for a young one and actually self-direct those funds to build further growth. Now, why do people choose to self-direct? I did bring that up in the agenda for the day, but the key points that people choose to self-direct from are the tax benefit in that you can grow your retirement product either tax-deferred or tax-free with the investments you make, in that when you're purchasing or investing into real estate or different things like syndication, there is no tax on the growth. It's either tax-deferred or tax-free if you're using a Roth product. You will only pay taxes on those tax-deferred accounts when you take distributions later on in life. A lot of people end up fatigued or tired of the stock market and decide, hey, I'd like to diversify my portfolio and start doing some things that I really control and have a little bit better grasp on. If you are an investor in real estate or any specific niche that you know, why don't you put this money to work there where you have more control of it? And then also, again, a new source of capital. If you're already flipping houses or already doing syndication investing and you hear this and realize, oh, I can take my IRA or former employer's 401k and put that into a syndication deal or my next flip, it's a great way to build up your investment portfolio. Another reason or set of reasons that these are good accounts and capital sources is that you can easily reinvest. If you find a syndicator that you like working with and they provide good returns, it's very easy to redeploy funds with those syndicators. Typically, we just need to execute a new operating and subscription agreement for whatever deal you're rolling the funds out of and into, and it's a very simple way to do that. Something that you can definitely take advantage of if you're not expecting to retire and start drawing from this money soon. So if you don't plan to use the money in your retirement account for the next 5 to 10 years when you're retiring, why not park it into a syndication investment or something that you have a higher chance of growth than, again, that volatile stock market or other assets that you're just not so sure about. There's better returns in most assets that you find than the simple CDs or stock market with the fluctuation. And you don't need outside approval when you're investing with a self-directed account. It's you doing the due diligence, you self-directing any investment you decide to make. With that being said, we do always implore you to use your network. It is the best thing to do is to build a network in your community or via this Pitch, Promote, Prosper event I brought up, and be comfortable with who you're investing with and where you're placing your money. And having said that, I do have a brief disclaimer. Advanta and its employees do not endorse or promote any specific product. We do not provide investment advice, tax, legal, or financial advice. We always implore our clients and our network to do all of their own due diligence, consult your own attorneys, accountants, and financial advisors before entering any type of investment. So that concludes most of my side of the presentation today. I'm going to go over a quick case study of how to invest a retirement account into a syndication deal. And then I'm going to turn over to Charles, who's going to bring up some topics and points that you want to look for as you're prospecting syndication investments. So in my scenario today, we've got Larry and Malcolm. Larry is a retirement account holder who is looking into syndication investing. He's got a retirement account with a larger custodian, and he just wants to get some of that money placed into a private placement deal, or a syndication, in other words. He meets Malcolm, who is a syndicator and has an apartment building locally to Larry that he'd like to find out more about. So Malcolm provides Larry with the subscription agreement and prospectus. Sometimes you'll see that as an OM or a PPM. And the minimum investment in this case is $50,000. So what Larry does is he finds Advanta, sets up a self-directed account with us. Part of that setup process, we would provide a transfer request form to move the funds from Vanguard to the Advanta account. Again, this is a non-taxable transaction with a custodian to custodian transfer. There's not even any taxable reporting done. It simply moves from one retirement account custodian to the next, typically within a few business days. And then also we submit the paperwork to fund the investment through Malcolm, which is covered here on this slide. The process is that the account manager that I referenced earlier, the role I used to serve, actually coordinates directly with Larry and with Malcolm to get those subscription documents executed in the name of the retirement account, utilizing Advanta's trust tax ID number, not Larry's social security number. And once we receive Larry's approval of all of that paperwork, we execute the subscription documents and send out the funds to the syndicator. Moving forward for this investment, Malcolm's partnership pays an 8% preferred distribution to all subscribers, which on a $50,000 deal breaks down to $4,000 a year for Larry's investment. And in year 5, the project's refinanced and Larry's retirement account receives a lump sum of $65,000 as the final payout. So in the course of 5 years, Larry's retirement account has earned $20,000 in yearly preferred distributions and also a $15,000 profit on the end for parking that $50,000 into this syndication deal for 5 years. And again, when you put that into perspective, that $35,000 of growth is either completely tax-free if Larry's account was a Roth IRA, or tax-deferred if it was a traditional IRA, meaning he does not pay $35,000 worth of taxes at the time that these monies are returned back into the retirement account. He does have to pay taxes when he distributes them out of the retirement account, which would be handled later either as a required minimum distribution when he reaches that age, or at any point once he's eligible to make distributions that he chooses to do so. So with that being said, I'd like everyone to just take a second and determine what type of investor are you. There are active investors which actually like to do rehabs like fixing and flipping or having direct control of what the property or what changes are going to be made. And that's perfectly fine. You can do active investments through passive investing strategies. We're covering those in different webinars and at different times, but that's probably not what fits into a syndication investor. So for syndication investors, you're going to be more of a passive investor where, again, you'd like to just park your money somewhere and let someone that knows what they're doing handle those types of day-to-day operations and the actual commitment of making sure the investment follows through to the plan and to the prospectus. It's very easy to start a self-directed account. It only takes about 15 minutes to complete an application. Again, we pair you with a client account manager that's educated in what the IRS does and does not allow within these accounts and able to help you strategize by talking through ways you can structure your investments and get these things done. Please do your own due diligence. Having said that, you can easily fund the account with typically completely tax-free or tax-deferred contributions and rollovers or transfers from previous plans. Those are things we'll work with you at the onset of what's best and where you're moving your money from. And once your account's set up, it's very easy to start investing. Your client account manager will walk you through all those steps. All right, at this point, I'm going to pass over the presenter role to Charles, who will go ahead and start with his portion of the presentation. Again, if you are having any questions as we're going, please throw those into the question box. We will address those after Charles has had a chance to make his full presentation. Charles, you should be getting the invitation to present right now.
Corey, I just received it and we will start up right here. Let's see if we can get this in presentation mode. There we go. So guys, we're going to be doing a brief overview today on what you should be looking for as a passive investor when you consider investing in a syndication deal. So here we have a summary of the different topics we're going to discuss, and we'll dive right into it. So the first thing is there's three components to any syndication deal. There's the sponsor team. That's going to be the team that's running the investment. There's the location, and there's the property itself. Of those three things, I would tell you that the sponsor team is the single most important one. It's often said that a good team can take a bad deal and run it well, whereas a bad team can take a good deal and run it into the ground. So always keep that in mind. The deal itself is important, but the team behind the deal is far more important. Okay, so with that being said, the first thing you're going to look into is the track record of the sponsor team. So what are some things you might want to look into and ask? So the first is, how many deals have they closed? You know, I think one thing that most people as investors look for is experience. You know, the same way that if you were going to a heart surgeon, you don't want somebody who's fresh out of medical school, you want somebody with 25 years of experience that's done this thousands of times. Well, same thing here. You want somebody that's done syndication deals, that's got some seasoning on them. And it's not to say that the entire team has to be seasoned, because we all start out new. Nobody starts out with 20 and 30 years of experience. But you want somebody on that team that has the experience. So it may not be the entire team, but at least make sure somebody has that track record. How many deals have they went full cycle on? So for anybody brand new to syndication, full cycle simply means from acquisition to disposition. So it means not only how many deals have they acquired, but how many have they actually sold. Why is that important? So the reason that's important is because that's when you can see the return metrics that a syndicator actually delivered to their investors, which brings us to the next question. What type of returns did they deliver to their investors? So as you get into a deal, what's going to happen is going to be something called a PPM, and there's usually an investment summary, some of the terms that you heard Corey mention earlier on. And within those documents, they give you certain parameters of what to expect from that investment. So what you're asking in this question here is, how did the performance they have actually compare to what they projected? So if they projected an 18% return and they delivered 16, then it didn't perform so well. It wasn't a terrible performance, but it wasn't the way it was expected either. Conversely, if they projected 18% and they delivered 20%, then that's probably a good sign. And another thing I would tell you is to speak with other investors that have actually invested with that sponsor team to see how their experience was. Do they feel that they got enough communication? Do they feel they had too much communication? Did they get distributions when they were supposed to be made? Were the returns that were projected at the beginning delivered on? So you can see those different things by speaking to other investors, because that will probably be the best measurement of how somebody actually performs. Okay, so the next thing we have is relevant skills and professional experience. So aside from just track record, what is the background of the sponsor team? What are they doing now? What have they done in the past in their professional careers? What qualifies them to be able to run these investments and to safeguard your investment dollars and to make them grow? And the first thing you want to know here is, who are the players on the team? So just like any team, it's important to know who's there, and you want to know what they do. So what you don't want is a team where everybody's overlapping and on top of each other. You want clearly defined roles, so that way you know what each person does. So, just like if you're playing baseball, while it's okay to have a couple of utility players, generally you want somebody who's going to be a shortstop and somebody who's being a right fielder. You don't want the right fielder playing shortstop. And same thing here on the syndication team. There's different positions. So you're going to have somebody who's going to be in acquisitions, which usually means they're probably finding deals. You're going to have somebody who's going to be investor relations, which they'd probably be the primary contact that any passive investor would speak with. And you also have somebody that's going to be asset management, which they're going to be in charge of the ongoing operation of the property once they're required. So, and then from there, you'll have different positions as well, but those are your high level positions. So who does what, and do they have the right players in the right positions? So outside of syndication, what backgrounds and professional experience do they have? So if you have somebody who's a lawyer or an accountant, they probably have certain expertises they can bring with them to different aspects of the syndication business. Conversely, if you have somebody who's been in property management, maybe that's a natural transition to asset management. So what have they done in the past, and what are they doing currently, if anything, aside from this, that qualifies them to be in the role they're in? The next two questions are more so about growth. So if you're just doing one deal with the group as they're starting out, perhaps these next two questions aren't so important, but if it's a group that you're looking to invest with over and over again, what you want to understand is, what does the organizational structure look like? How big of a team do they have? Do they have any staff? Do they have any support personnel? Because what you'll realize is that as a group grows and they get more and more syndication deals under their belt, they're going to need more players on their team to be able to execute them and to be able to deliver on the returns that they projected, simply because of time constraints. If you have a small team with 2 or 3 people and they're running 10 or 15 properties and still looking for new ones, then you're quickly going to wind up running out of time. So you need an organization that has the financial wherewithal and the structure to be able to bring that personnel on, or to already have it in place. And then the last thing is, what systems do they use to run their business? And that's something that I think a lot of larger equity groups look at when they potentially vet sponsor teams, because they want to see, how efficiently are they running their business? Are they using technology to their advantage? Are they doing things smartly, and are they doing things in a way that's going to allow them to maximize their time and their revenue? Okay, so next thing we have here is, does the sponsor team have good vendor relationships? And you might be asking, well, why is that important? So the reason that's important is because ultimately that can dictate how successful or unsuccessful the investment is. Because the sponsor team is going to run a certain component of it, but then there's other things they're going to be reliant on their vendors for. And it happens in all different things. So on this slide, we talk about some of those different relationships that are important. So one relationship that's very important on the acquisition side are real estate broker relationships. So for me, I know that all of my deals come from real estate brokers. So it's very important for me to maintain good relationships with brokers on a regular basis. Same thing for any other syndicator. Next one here, we reference is financing. So mortgage brokers and lenders. So right now, I'm sure a lot of you are aware of what's going on in the markets. We've had interest rates rising. We've had a lot of uncertainty. And because of that, it's very, very important, more now than before, to have good financing relationships. Because it's very easy to have a deal where somebody goes in and they make some assumptions on their financing, and then all of a sudden the actual result comes out vastly different because they had a lender that just couldn't deliver on what they projected. The next thing is property management. So property managers are going to be really vital. Why are they important? So they're going to serve two roles. So one is they're going to be able to give you guidance before you put offers in. And for any syndicator, I would always recommend that they should be out there consulting property management companies on a regular basis, because ultimately the property management company is going to be the one executing the business plan after you buy the property. So you need to have their stamp of approval to make sure they're on board with it. The last thing you want is an operator who's going out there projecting certain rents and then not having a property manager that feels confident in hitting them. So it's very important for the operator to have good management company relationships and to be utilizing those relationships on a regular basis. I would actually say of all the relationships on here, strictly from an operational and performance standpoint, property management company ones are probably the single most important one. And same thing with insurance. So similar to a mortgage broker, the insurance broker is going to help get you the right insurance and get you the right coverage for that investment. So that can be important. Things happen. You have fires, you have natural disasters, you have all sorts of occurrences. So while it may not seem important to have good insurance, it's vitally important when you have an event like that. And unfortunately, when you have an event like that, it's too late to get good insurance, and you need it beforehand. So having teams that have these relationships go a long way. One thing I would say, something I found for me personally that works, I know there are other operators that do things a bit differently, but I think it helps to be focused in a particular area or region, because even though you could theoretically, use some of these vendors nationwide, it's certainly a lot easier when you're using them in the regions that they're strong in. Because most vendors, they tend to have regional setups, and you have to look at what their structure is too, the same way that you would examine a sponsor team. So the sponsor team should be doing that with their vendors. Okay, so next thing we have here is assumptions. So one thing that's very important with any investment that you look at for syndication is what assumptions are made, because all investment summaries for any deal are going to be built around assumptions. And sometimes those assumptions are good assumptions, and sometimes they're not. So the key is you have to get used to looking at them and get a basic comprehension of what seems realistic and what seems like it may be a bit of a stretch. Okay, so the ones on this slide here are all constant items that you'll need to be aware of in any market conditions, whether it's now, whether it's 6 months ago, whether it's 12 months in the future. So the first thing is rent growth assumptions. And what you want to see is, are the sponsor team's assumptions realistic, or are they exaggerated? Now, if you're not familiar with the area where the investment is, you may not know that right off the bat, so you may have to do a little homework. And you could even ask the sponsor team to provide any information they have. There's a good chance they probably have some rent comps, and they probably have some information based on the research they've done. So they could probably share some of that information with you, so you can make your own determination about whether or not it seems realistic. Next thing is terminal cap rate. So for anybody brand new, a cap rate is a metric that's used to take the net operating income and divide it by the purchase price. And a lot of times that's going to be a measurement of how aggressively properties are being sold in an area. So a terminal cap rate is the cap rate that's being applied to the sale or refinance. So it's usually on the back end of the property. So in general, you want your terminal cap rate to be higher than the current market cap rate for similar assets. Now, some people will tell you that it should be higher than the acquisition cap rate that you're buying the property for. That's not necessarily true, because there are circumstances where that won't always apply. But using the current market cap rate for similar assets in the area is probably going to be a much better metric, because that's going to be something more stable that you can use to measure and gauge off of. Now, if you're not familiar with the cap rates, again, you could ask the sponsor team for that, or you could probably even do some research online and find out. But oftentimes for me, as an operator, usually brokers are going to be my best source for getting cap rates. Okay, so the next thing is financing assumptions. So are they based on some type of merit, or are they strictly guesstimates? So when you've been in the business long enough, you usually could put a guesstimate together that's going to be fairly accurate. But even with that, it's always better to have real documents. For me, I look at a lot of deals, and I'm sure that's the case with many operators. So do I reach out to a mortgage broker or a lender for every single deal? I don't. But if it's one that I have potential on and that I can be competitive on, or if it's one that I win for sure, I absolutely go out and I get a term sheet. Now, a term sheet is going to be preliminary in nature. What's going to happen is usually that's going to be a mortgage broker or sometimes a lender looking at it. And they're going to give you their perspective based on the financials of the property of how much they believe they can lend and on what terms. Now, keep in mind the term sheet is a starting point. It doesn't mean that that's what you're actually going to get. So that may still change from beginning until the time the loan application is actually approved and closed. But it'll give you a fair degree of confidence, and it shows that the sponsor team did their homework on it. Next thing is tax projections, and this is going to be a big one. So you want to make sure that the sponsor team contacted the assessor's office to confirm that their assumptions are correct. There are some teams out there that may use generic formulas, and that's good for a starting point, but you should never trust an item as important as that to a generic formula. Taxes vary big time from area to area, and there's a lot of different assumptions, so you really need to be clear on what the assessor is doing in that particular market, because it really varies from county to county. And then insurance. So similar to financing, did they get an insurance indication? So the indication is basically a soft quote. Now, again, that can change from the time they get that indication until they actually get their premium finalized. We had that happen on 2 deals pretty recently because they both had open claims. And unfortunately, they're things that we couldn't really have predicted up front, but you have to adjust. So the key is at least having the indication shows that the numbers are based in something, and then it's the understanding that those numbers could potentially change as you go throughout the deal. Okay, so now the next things here are more specific to the time we're in right now. And some of these things will apply in normal times or in different times also, but they really apply right now, and it's important to be aware of. So the first thing is, and I'm sure everybody here is probably aware of this, interest rates are rising. So right now, rates are in the 5 to 6% range for most multifamily properties. What I would say is that, historically, they're still low to where rates were in the past. But at this point, it's the more distant past, because the more recent past, we've had very, very low rates. As recently as January or maybe early February, a lot of rates for multifamily properties were in the 3s. So 5 to 6 is a big jump. The reason I mention that is you want to make sure that the groups you're looking at are using realistic rates. Now, if they're doing a loan assumption or if they're doing something that may allow them to obtain a better rate, great. But if you see groups that are using 3% rates in their underwriting and it's not an assumption, I'd probably be very skeptical of it personally. So next thing is cap rates are starting to decompress. So what does that mean? So if cap rates decompress, that means prices start coming down. And that's been happening so far throughout the year. So for anybody in here that is interested in institutional quality assets, those are your nicer properties, usually your nicer, larger, better part of town type properties. Those have dropped a little bit depending on who you ask in the areas that I'm in, anywhere from 5 to 10%. And with the value of stuff, some of them as much as 20%. So the reason I say that is you want to make sure that your sponsor team is doing their homework and that they're aware of where pricing in the market is right now, because that's going to be very important. Prices are changing very rapidly right now. Okay, so next thing we have, really the next 3 things are all about adjustable rate loans. So right now, the bulk of syndication deals are getting done with adjustable rate bridge loans. So there's 2 types of debt, recourse and non-recourse. Recourse means that there's a full personal guarantee. Non-recourse means there's a limited personal guarantee. But the good news is, as a passive investor, neither of those things will apply to you, because that's the risk that the sponsor team is going to take on. So what does that mean in terms of adjustable rate loans? So adjustable rate loans can literally change from month to month, because what's going to happen is there's 2 components to your interest rate. There's an index, which most loans usually track the 30-day SOFR rate, and then there's also a spread. So the spread is the amount of money the lender makes. The spread is usually constant, but the index changes, regularly. So as that index changes, the interest rate can also fluctuate with it. So what does that mean? So it means that there's two main things that are going to change. One is that most lenders that are doing these types of loans right now are requiring a rate cap. So a rate cap, similar to insurance, it basically acts as a hedge in that it protects you in the event rates go up significantly. Now, the actual cap itself is going to vary from deal to deal. It'll be partly dependent on the loan documents and the lender's requirements. And most of them start somewhere 150 to 200 basis points above where the going in rate is. So what does that mean? It means that potentially, from where the interest rate is now, let's just say 5, if it goes up 200 basis points to 7, then the cap doesn't give any coverage. But if it goes up to 7.5, now all of a sudden the cap kicks in and it covers anything above 7. So that's what it would kind of mean. But what it means initially for your investment is making sure they have enough money in there for it. These caps have gotten very expensive. The cap providers realize that there's a lot of demand for their product and a lot of need for them right now. And because of that and market volatility, they're raising the price of these. So you need to make sure that the operator included that in their underwriting, so that way they don't have to come back and ask for more capital later on. Same thing with the debt service reserve. So most bridge lenders at this point are withholding 6 to 12 months of debt service. And the reason they're doing that is they're realizing that with these adjustable rates, it's possible that rates could go up 150, 200 basis points before a cap kicks in. And by doing that, that could impact the cash flow of the property negatively. So instead of putting the borrower and ultimately the investors at the risk of losing their money, what the lender is doing is they're holding these funds in escrow. And if somebody does not have enough cash flow to pay the mortgage for a given month, they dip into that reserve and they're going to take it out of there. So that's something they have to factor in also, because that's additional money that's going to need to be raised. You want to make sure your operator includes that in their underwriting. And the last thing is market volatility as a whole is high right now. So that means things change, and they can change on a daily basis, sometimes even more than that. So the reason I mention that is because, unfortunately, even with operators that are doing all their homework right now, things are changing on the fly very rapidly. So they may present the deal to you one way, but then unfortunately a month later, as the deal actually gets ready to close, quite a few of those assumptions may have changed just because market conditions themselves have changed. So something to be aware of. Okay, so next thing is location. Location, 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 right? So 3 most important words in real estate. So the sponsor team is probably the most important component of any syndication deal. Location is the second. So if you're listening, there's only really 3 components, and the property itself is really the least important, keep in mind. So why is the location more important? Location is more important because you can't change that. So a good operator can go in there and they can turn around a struggling property. They can do things to improve safety at the property. They can do things to improve operations at the property and collections. What they can't do is change the entire area. So that's going to be very, very important. It's often said you don't want to have the best property in the worst area. And I think that's something to keep in mind as you're looking at investments. So in general, you want to be investing in growing or stabilized areas. You want to stay away from areas that are on the decline unless there's a really compelling reason to invest there. So, one of the benefits that comes with having local knowledge is you can see when an area is starting to turn around. And maybe somebody who's further away and who's not in the market may not have that advantage. But if you see something that other people don't, then by all means invest in it. But make sure you do your homework. Make sure you feel really confident, because the last thing you want to do is be banking your retirement on a bad area. Okay, so what factors are important as you look at an area's health? So you want to look at job growth and you want to look at household formation growth. So those are going to be your 2 big ones. If those numbers are growing or at least stable, there's a good chance you have a solid area. If we get to a point where you start seeing significant growth, and significant growth is probably 2% year over year on a regular basis in the area, then there's a good chance that market's probably very hot. Last thing I would tell you on location is laws. Laws are going to have a big impact on your investment. Is the area that you're investing in tenant friendly or landlord friendly? So what difference does that make? Well, it could be the difference of how fast you can get a tenant out if you have a problem. So for me, you might be able to tell from the accent, I'm originally from New York. New York's not too landlord friendly, especially if you're in the city. You know, I've heard many horror stories from friends who have had properties where they've had tenants sit there for 2 years without paying any rent. Right now in Charlotte, North Carolina, I invest primarily in the Southeast. The regions down here are generally more landlord friendly. You know, in South Carolina, in most parts, I could probably have somebody out in 30 to 45 days. So that's a big difference. You know, think of it this way. If you have a non-paying tenant and you're able to get them out in 30 days, is that a lot more favorable for your investment than if you have to keep them in there for 6 months or a year? And the answer is yes. So just be cognizant of that as you look at investment opportunities. Okay, so now the last thing, and perhaps the most important. So it's great to go out there and find a good sponsor and to invest in a good area and to have the right property, but you need to have something that's the right fit for you. And as Corey said, you know, when you have a self-directed account, it's self-directed, so you're in charge. So every investor is going to need and want something different. You're going to have some people that may be older, maybe they're in the retirement years already, and maybe they need that cash flow month after month to live. So if that's the case, they probably don't want to invest in a development deal that's not going to have any cash flow for 3 years. You want something that's going to be cash flowing right away to be able to sustain that lifestyle. If you have somebody in their 20s or 30s who's still building up a retirement account and they're 30, 40 years away from really needing that to live, maybe they don't really care about cash flow and they're looking for overall yield. So figure out what's important to you and what you need in your portfolio to be able to really capitalize on it. And then you can find an operator and a deal that fits your needs. So those are some of the different things we have. And then also my contact information if anybody wants, and I'll turn it back over to Corey for any questions.
All right. Thank you very much, Charles. I appreciate your information there today. I do have some questions here in the chat box. I've got a few questions I've raised myself in listening to some of the things that you've gone over. So I'll get started with that in just a second. Before I do so, I want to implore everyone, if you still have questions and have not added them to the question box, go ahead and do so now. We're going to start that portion now, and once we run out of questions, we'll go ahead and wrap up. So with that in mind, also take down Charles's contact information. I'm actually going to, Charles, if you don't mind, switch back to myself as presenter, and I'll put the slide up that's got both of our contact info on it.
Yep.
There we go. Okay. So with both of our contact information here and the questions at my ready, Charles, first off, what is a PPM? Can you describe that in a little bit more depth? I briefly went over just a private placement memorandum.
Sure.
I'm familiar with seeing them, anywhere from 50 pages to 150 pages, but what should an investor look for that to contain in general?
Yeah, so the largest, there's really two things it's going to contain. And as Corey said, they can vary because they can be very thick. But the two things they're really going to contain is basic information about the investment. So what is the investment? What's the cost of the investment? What's the minimum and maximum levels of participation in the investment? And are there any specific guidelines around it? And then the second thing it's going to contain, and probably the most important, is all of the risks that are associated with that investment. So keep in mind, guys, every investment does have risks. So, while syndication is a great option, it's not risk-free. So the PPM is going to outline all of the different risks associated with the investment.
And one question I actually raised myself, how do you find access to previous investors? That was one of the things you mentioned at first when you're prospecting syndicators. Is that something that they may have in the PPM, or when you're speaking with the sponsor that you can ask them directly? And even in that case, you're probably just getting access to the ones that they know are going to say good things about them. Is there any other market that you can use to find investors that have previously worked with a sponsor?
Good question. So you definitely won't see that in the PPM. But speaking to the sponsor is one way, but you're right. Nobody's ever going to give you somebody that'll give them a bad reference. So you're right on that. The other way is just speaking to other investors in the community. So I'd imagine here, if you attend webinars like this or similar webinars, there's probably some people on here who have invested with different operators, and you could probably speak with them and have a telephone conversation or a Zoom meeting and kind of pick their brain to see how the experience with operator X or operator Y was.
And how often do limited partners have to make additional contributions to a deal? In my experience, that's a case-by-case basis that would be listed out in the subscription agreement or the private placement memorandum. Some deals take all the cash up front. Some deals may have different staunches or progressive points where they do draw more money from their investors. Charles, do you have a kind of a rule of thumb or understanding of what you see on a common occurrence?
Not really. So I think you hit the nail on the head, Corey. It's really case by case. So there's two instances when you might have additional need for capital. The first one, as you said, is if a deal is planned that way from the beginning, where maybe if they're doing a development deal, they don't need the full amount of funding right at the beginning. They may need 25% of it, and then they may need another 25% a year later. So they may wait that year so that way they don't have to pay out on that full amount earlier on. The second time is when something either goes wrong in the operations or the operator made a mistake in their underwriting and they didn't raise enough. And at that point, that's going to be called a capital call. And what they would do is they'd have to go to the investors and say, look, we need X amount. Everybody's going to be responsible. And in most cases, if an investor does not contribute to that, then there's a chance their percentage interest could be diluted in the investment. Now, what I would ask, what I would tell you actually when you're speaking with sponsors, it's probably a good idea to ask them, have you ever done a capital call? It's a good question to ask because I think that's a concern, obviously, that a lot of investors have, and it's a very valid one. One thing we always like to do is to raise more money than we think we need, with the idea being that we don't want to do that. Now, the downside to that is, yes, it will hurt the return by doing that. But to me, I'd rather dilute the return than have to go back to the investors and tell them we need more money.
And something you mentioned did raise a good point, at least in my mind, is if something does go out of plan for an investment and they do have the need to make a capital call, what are the options or abilities for an investor to say, nope, I'm done. I don't want to have myself exposed to any further risk of loss? Is there provisions built into the operating or PPM typically for an investor to pull out, or once they sign and send the funds in, they're kind of locked in for the duration of the deal, however it goes, like a roller coaster? What is your experience there and feedback to that effect?
Good question. So one of both the pros and the cons to syndication, depending on how you look at it, is that it isn't a liquid investment. So what does that mean? So stocks are very liquid. You can go in and you can buy 100 shares of Apple today and you could sell them an hour later. You can't do that with this. So the downside to syndication is once you're in it, you're in it. Is there a way out? So that's going to be on a case-by-case basis based on what's outlined in the PPM. Generally, there is a way out, but the way out is very tough because most PPMs will make it the responsibility of the investor to find somebody to replace them. So if Jane Doe comes in and Jane Doe decides a year later that she needs her money back, but she doesn't want to be involved anymore, and the syndication is not ready to liquidate, then the only way that Jane Doe is going to get out, if she goes out and she finds John Smith and she says, okay, I'm going to sell X percentage to John Smith for this, and then as long as the operator approves of that transaction, that can happen. But they are very illiquid, so it is tough to get out. Now, an investor does have the right to say, no, I will not be able or I'm not willing to contribute more capital when a capital call happens. So they can certainly keep their position in the deal with the understanding that the position may become diluted if other investors do contribute to the capital call and they don't.
All right. Well, that is some useful information. I know I've had a few clients ask me at the onset, like, what if I make this investment? Can I just come back to Advanta and say, hey, I want to pull my money out of it? And, from our side, we do always have to refer and defer to the sponsor as to how those clients can work that out as well. Someone just asked, how would Jane Doe find John Smith? I think that falls back again to your investor network, whether it be your local community, your local RIA groups, or whatever you're doing as an investor to network with other investors. I don't think there's a specific forum for, hey, I want to jump into other people's investments when they want to fall out of it.
Right.
It's really just, having those right conversations, correct? Yeah.
Correct. Yep.
Okay. Next question. Are there any roles that one could prefer a utility player to serve due to the crossover of expertise? I think specifically you referenced, if someone's got experience in property management, maybe having that person serve in the general partner side as an asset manager would be a good crossover. Are there any other roles as a sponsor that you would want filled by someone that can serve as a utility player that has, a high level of crossover experience?
So I think the ones that would be best at crossover are probably people that are more generalists than specialists, and that they have a lot of general knowledge in different things, but they don't really specialize in any one. So for me, for instance, my roles included both acquisitions and asset management. Now, part of the reason that I was able to do that is I had a lot of background working for a guy who was a commercial real estate investor and serial entrepreneur, so I was exposed to many different things at once. So it's given me that ability. But what you'll find is that oftentimes they may wind up being two different skill sets. So I think the best answer is just if you see somebody that's a generalist and based on their background, they've done many different things and had a lot of exposure, they'd probably be your most likely utility players. But in general, I think you want most people to be specific and really be, experts of what they're working on.
And just to further that point, Charles, if you're someone that's looking at a general partner role and you have a set of expertise but want to increase your knowledge and your overall well-roundedness, is that something that's a common occurrence where you may shadow someone in one of the other roles or just kind of learn from them so that maybe the next deal you can take more of a role to what you're looking to gain in expertise or knowledge? Or is that not typically an industry standard? You stick with what you've got and maybe find a different partnership group if you want to fulfill a different role?
So I think it'll really vary from person to person, group to group, but I think for anybody who wants to learn, there's always opportunities to do so. So if you're somebody that, they want to be in a different role, they want to learn something different and do that, there's always ways to figure that out. What I would say is sometimes you also have to be realistic because there's the reality of, wanting to be something and actually being good at it. And, to me, maybe in some ways I'd probably like being the investor relations guy, but I also know it's probably not the best use of my skill set. So for that role, you might need somebody who's more social media friendly. You might need somebody who's a more natural salesman. So that's not really my strength. So that's probably where I'm not the right fit for that role. So you can always find ways to get into something that you want, and you could always learn and grow. But it's just figuring out where does the balance of doing what you want, but also utilizing your skill set, where do those two things meet?
Perfect. And the last two questions I've got here, in relation to location, is crime rate something that you look at as maybe a tertiary factor, or is that something that has a likelihood to change and you don't necessarily consider as heavily as some of the other items that you brought up when speaking about location?
So I wouldn't really consider that as strongly. I think it's a good indicator overall for our country, but probably not as relevant when you're looking at individual real estate markets. In terms of actual financing, for many of these deals, regardless of what location you're in, most lenders have an index they're going to track, and the overwhelming majority of them are using the 30-day SOFR rate more than the prime rate.
All right. And the final question is really a chance for you to kind of promote what you've got going on as well. Someone just asked about cashflowchamps.com. They asked if the website worked. I don't know if they tried to pull it up and maybe had an issue getting to the URL, but if you just want to describe what that is and where, I know that's a recent endeavor of yours, the Cashflow Champs transition by following your LinkedIn. Just let us know what you guys do at Cashflow Champs, how we can get a hold of you, and anything else you would like to pass along as a closing message.
Yeah. So with Cashflow Champs, even though I do have it in the contact info, it's actually under construction, so I need to have that put up there. But yes, that was a recent transition actually within the last couple of days because I just left one position and started with this. And essentially what we do, we're a full service syndication operation. We focus primarily on multifamily investments. We are working on some other asset classes as well, but multifamily is really our bread and butter at this point. And we focus on acquiring properties in the Carolinas, Georgia, Florida, and Virginia. and we were actively, looking for new investors and growing our team.
Perfect. Well, Charles, thank you so much today. I know that you will do amazingly in this new role and with this new organization, because just simply the nature of my experience with you, you've been an expert at educating and making things that I don't understand before you bring it up, something that I walk away just knowing pretty well how to explain it even on to the next person that I speak with. So with that, and just with what I've learned and met with you and networking with you, I definitely think you guys will be very successful and do well as you move forward. For everyone that's participated today, I have dropped a PDF of these slides into this session as a handout. You can also reach out to me directly if you'd like a copy of my or Charles's slides. We're happy to send those out as a PDF. As I referenced earlier in the webinar, you should be receiving a recording, or if you signed up or sign up for any of our future webinars and cannot attend, we always email out the recording. You can also find it on YouTube, and that is something that we always provide as free. We never charge for our educational endeavors, and we always try to get great expert guests like Charles to come in and speak with their expertise and kind of pick up some things that we might not necessarily know, but with the expertise and help of someone like Charles, you get that information passed along to you at no additional cost. Thank you so much for everyone participating. Charles, thank you again. I look forward to seeing you again later this month at the Multifamily Investor Nation Conference in a few weeks. And again, as always, the Multifamily Investor Nation group that you run in Charlotte is a great wealth of knowledge. If you're in that area, come check that group out as well. Thank you all. Charles, thank you, and have a great rest of your day.
Thanks, Corey. What I would also say, if it's possible, to mention one quick thing.
Go ahead.
Every Saturday at 4 p.m. Eastern, I host a free underwriting session where we actually underwrite a multifamily deal. So if anybody's interested, feel free to reach out and we can get you added to that list if you want to attend.
I think I will actually reach out to you to participate in that soon. Underwriting is something, as I just mentioned, I don't know too much about. I have an interest to learn more just from a general understanding standpoint. So I think I'll reach out to you individually to take you up on that in one of these upcoming sessions.
Good. Okay. Well, thanks so much, Corey. I appreciate being a guest on the webinar today.
Yep. Awesome. Well, thank you very much, everyone. Have a great rest of your day. Charles, thanks again. And I will go ahead and close everything out here in just a second.
Great. Thank you.